The real asset investment class really consists of three main areas: infrastructure equities, real estate equities, and fixed income that is issued by real asset companies. We also have the ability to tactically allocate to natural resources when we think the investment opportunity is particularly compelling. So we're investing in publicly listed equities and liquid bonds. It's a global opportunity, and we have a focus on developed markets as opposed to emerging markets. We believe that real assets offer an interesting combination of current income plus predictable growth over the long term. And that's really because of the underpinning hard assets or critical infrastructure within the asset class. So the current income of the asset class is somewhere around 4 to 5%. The cash flows tend to grow in the range of 4 to 5% every year, in line with GDP plus inflation. And that's because these are assets like toll roads that people are using every day and volumes and pricing is increasing, or water utilities that people are consuming throughout an economic cycle. Within each of those investment sleeves, infrastructure, for example, would consist of things like toll roads, airports, container port terminals, communication towers, water utilities, electricity transmission grids, oil and gas pipelines. So it's a relatively diverse asset class. It's global. Within real estate, again, these are publicly listed real estate companies that would own commercial office buildings, shopping malls, public storage facilities, data centers. So it's literally the bricks and mortars. About half of the opportunity set is in the US and the other half is spread around the world, where we want to invest in good quality companies, whether they're shopping mall companies or office buildings, where they're going to have the ability to increase the rents over time, and there'll be a degree of capital appreciation and inflation hedge over the long term. The third component is real asset debt. So these are typically bonds issued by infrastructure companies, real asset companies, natural resources companies. And what we found within the fixed income space is that we can get a very comparable current income dividend yield compared to the broader credit markets. But the volatility is much lower. The risk of a default is much lower. And when there are company-specific issues, the recovery rate tends to be much higher. And that's not surprising, given that the underpinning assets of these companies are these essential types of services of airports and toll roads and shopping malls and office buildings. And that's really the fundamental approach to real assets, whether it's from an equity perspective or within the fixed income. Natural resources is the fourth component, where we have the ability to tactically allocate to natural resources when we find there's something particularly compelling. That would include timber and agricultural companies, more upstream oil and gas or mining companies, and that tends to be very cyclical. We do not have a strategic allocation to natural resources, but again, we can tactically allocate to that space when we see a compelling opportunity. What we constantly hear from investors is that they're drawn to real assets for a couple of reasons. One is the current income. In today's low interest rate environment, getting a 4 or 5% current income is a good starting point. The second component, which I think is often overlooked, is the growth potential, that these companies tend to grow their cash flows mid-single digit year after year after year. And what that translates into is a portfolio that tends to be lower volatility, good income with some growth, and also low correlation, lower beta to other asset classes. I believe it's a great fit for investors when they've got a longer term investment horizon. When they're thinking out over the long term, they want an asset class, an investment that will give them some good current income, but it will have that consistent capital appreciation measured over the long term.